So you just got denied for a business loan.
Yeah. And it's a brutal feeling.
It really is. You're sitting there, I mean, you're just staring at an email on your phone,
Right.
right?
A very polite but totally devastating email.
Exactly. And your credit isn't even terrible. Your business is actually making money, and you've been waiting, what, 60, maybe 90 days for that SBA or traditional bank loan to finally come through
Just checking the portal every single morning.
every morning, only to finally get a formal, no thanks.
And it leaves you completely stranded. I mean, you need that capital for payroll next week or to fulfill a massive inventory order, and suddenly the runway you thought you had, it just vanishes.
But here is the reality check that you really need to hear right now. Being rejected by a traditional bank, that puts you in the vast majority.
Oh, absolutely.
80% of small businesses get turned away by banks. You are not an anomaly. And there are entirely different avenues of funding out there, like a whole alternative capital ecosystem that will look at your exact same business profile and say yes today.
Yeah, so today we are dissecting that fast funding alternative lending landscape. We've pulled together lending data, legal contracts, and financial mechanic breakdowns from all across the industry to see how this hidden ecosystem actually operates.
Right. We're looking at data from NerdWallet, underwriting manuals from factoring lenders like Apex and FundThrough,
Yep.
plus some really heavy legal insights on commercial contracts from J. Singer Law Group. And our mission for this deep dive is to empower you. We are going to unpack exactly how non-traditional lenders operate, how they can fund a business in days instead of months, and most importantly, how you can navigate the hidden legal and financial traps of this alternative world.
The goal here is to move you out of that post-rejection paralysis, right, and get you into a highly strategic position.
Exactly. So I want to start by just dissecting the rejection itself, because traditional banks and SBA loans, I mean, they're fantastic on paper because the rates are low.
Right, the cost of capital is cheap.
But the process is agonizingly slow. And the underwriting feels, I don't know, completely disconnected from how a modern business actually runs.
Well, that disconnect is systemic. It's built in. The traditional banking system fundamentally isn't designed to take risks on small dynamic businesses.
Right.
It is designed to protect the bank's depositors and comply with strict federal regulations. So when a bank evaluates your business, they're essentially looking in the rearview mirror.
So they aren't looking at my, say, $100,000 purchase order for next month. They're looking at my tax returns from 2 years ago.
Exactly. They want years of steady, predictable profits and usually hard collateral, like real estate. To a traditional bank, your past is the only acceptable proof of your future.
I was looking through the SBA loan guidelines we compiled, specifically the 7A program, and they've actually tightened their requirements recently. The minimum SBS score went from a 155 to 165. Now, I'm familiar with the personal FICO score, but what exactly is an SBS score, and why does a 10-point jump matter so much?
So SBSS stands for Small Business Scoring Service. Think of it as a blender.
A blender.
Yeah, a blender that mixes your personal credit history with your business's financial history. It looks at your business assets, your corporate revenue, and your personal credit card utilization all at once. And it grades you on a scale from 0 to 300.
Oh, wow. So if my personal credit took a hit because I maxed out my personal cards to fund the business last year,
The SBSS blender catches that.
and it tanks my business loan application today.
It catches everything.
Yeah.
And by raising that minimum threshold to 165, while simultaneously demanding trailing 12-month financials, the regulatory framework essentially blocks out early-stage, fast-growing, or recovering businesses.
Okay, let's unpack this because that feels incredibly punitive. If a business has recovered and is cash flow positive today, punishing them for a 2-year-old credit blip seems totally counterproductive. It's like they're punishing you for your past rather than investing in your future.
It is a structural flaw in traditional banking, without a doubt. But that flaw is exactly what created the alternative lending market. An online lender or working capital provider, they don't care about your rearview mirror. They care about your dashboard.
They want the real-time data.
Exactly. They look directly into your operating accounts. By analyzing your daily bank deposits, your revenue velocity, and your current cash flow patterns, they underwrite the future performance of your business.
That makes so much sense. That explains how platforms like Bluevine or Fundbox can approve an application in 24 hours. They aren't waiting for a committee to review your 2024 tax returns.
No, an algorithm is looking at your Stripe or PayPal deposits from yesterday.
And because they rely on real-time cash flow, they are willing to accept much lower personal credit scores.
Right, sometimes down into the low 600s.
Yeah.
or even 625. And they require a much shorter time in business, maybe just 3 to 6 months.
But speed and accessibility always come with a premium, right? A 24-hour turnaround means we are no longer in the realm of single-digit annual interest rates.
Definitely not.
We are talking about fundamentally different repayment structures, which leads us to some potentially dangerous territory if you don't know the mechanics. But before we get into the expensive loans, I want to explore a concept from our sources that completely bypasses the idea of taking on debt altogether.
Yes, the factoring alternative.
Right, because when you get denied a loan, your first instinct is just to go find a different loan. But companies like Apex and FundThrough highlight invoice factoring, which leverages money you've already earned.
This is a vital tool for B2B companies. If you sell to other businesses, you often operate on net 30 or net 60 payment terms.
Right. You deliver the product today, but you don't actually see a dime for a month or two.
Exactly. And factoring allows you to unlock that trapped capital immediately.
The analogy that helped me wrap my head around this is it's like a lottery ticket.
Okay, I like that.
Imagine you hold a winning lottery ticket for $50,000, but the payout office is closed for 60 days. You need cash for payroll tomorrow. Factoring is basically selling that winning ticket to someone else for, say, $48,000 cash right now.
That is a very accurate way to visualize it. You are selling an asset. The asset is your unpaid invoice. When you factor an invoice, the factoring company advances you a large percentage of its value, usually 80 to 95% within a day.
And they hold the rest in reserve, right?
Yeah, they wait for your customer to pay the invoice directly to them. Once the customer pays, the factoring company releases that remaining reserve to you, minus their fee, which typically hovers between 1 and 5%.
The mechanic that completely blew my mind here is the underwriting shift.
What's fascinating here is how it flips the script on credit.
Right. If I got denied by a bank because my personal FICO is 580, a factoring company doesn't care because they aren't underwriting me. They're underwriting the company that owes me money.
That is the absolute superpower of factoring. If you are a small, struggling startup, but your client is a Fortune 500 company or a government agency with impeccable credit, the factoring company is relying on their ability to pay, not yours.
So you leverage your client's financial strengths to fund your own operations.
Exactly. It bypasses the traditional credit system completely. You can scale without taking on a mountain of debt.
I can see how that's a huge game changer. But I do want to dig into a distinction that the financial guides from United Capital Source pointed out. They are very clear that we cannot confuse invoice factoring with accounts receivable financing, even though people use the terms interchangeably all the time.
Oh yeah, they're very different.
How do those two actually differ mechanically?
It comes down to ownership in your balance sheet. With invoice factoring, you sell the invoice entirely. The factoring company buys it, they own the asset, they collect the money from your client, and most importantly, it does not show up as a liability or debt on your balance sheet.
Because it is a direct transfer of an asset.
Right. Accounts receivable financing, on the other hand, is a loan. You do not sell the invoices. Instead, you pledge your entire pool of unpaid invoices as collateral to a lender in exchange for a revolving line of credit.
So with AR financing, I am essentially taking out a loan backed by my invoices, which means the debt goes on my balance sheet.
It sits right on your balance sheet as a liability. Furthermore, with AR financing, the lender usually does not handle collections. You still have to chase down your clients to get paid.
Oh, wow.
And you're paying interest on the borrowed money the entire time those clients delay payment.
That sounds exhausting. You're acting as a debt collector for your own clients while a meter is running on the interest. It seems like a massive operational burden compared to just selling the invoice outright.
It is a heavier lift, though it can sometimes be cheaper depending on your invoice volume. The key takeaway is knowing exactly what financial instrument you are holding, because the legal and financial implications are night and day.
Which brings us to the actual cost of these alternative options. Because whether you secure a working capital advance, an online line of credit, or a merchant cash advance, you have to decode the pricing. The documentation from Clear Skies Capital warns that the terminology non-traditional lenders use can be incredibly deceptive.
Deceptive is the right word. The terminology is where many business owners unknowingly sign away their profit margins. In traditional banking, we are all familiar with the annual percentage rate, or APR.
Right.
APR includes the interest rate and any fees, annualized over a year. It's a universal measuring stick. But in alternative lending, specifically with merchant cash advances, they rarely use APR. They use a factor rate.
A factor rate, which is usually expressed as a decimal, like 1.20 or 1.35. And it functions as a simple multiplier against the advance amount.
Exactly. If you receive a $100,000 advance at a 1.2 factor rate, your total payback amount is $120,000.
Okay, wait, I want to stop right there and clarify how this works over time. Because my instinct with any loan is to pay it off as fast as humanly possible to save on interest.
Naturally.
So if I take that 100,000 at a 1.20 factor rate and my business has a phenomenal month and I pay the entire balance off in 2 months instead of the projected 5 or 6 months, I assume I save money on interest, right? Like a rebate.
You do not. And this is the brutal mathematical reality of fixed cost products. A merchant cash advance is technically a purchase of your future receivables at a discount, not a traditional loan. Therefore, the cost is a fixed fee. The second you sign that contract, you owe $120,000.
So the cost is completely divorced from time.
Yes, paying it off in 2 months instead of 5 doesn't save you a single dollar. In fact, if we map that fixed fee back into an effective APR, which measures the cost of capital over time paying it off faster, actually skyrockets your APR.
Wait, really? How does paying it faster make the APR higher?
Because APR is an annualized calculation of cost. If you pay $20,000 for the use of $100,000 over a full year, that's roughly a 20% APR. But if you pay that same $20,000 fee for the use of the money for only 2 months, you're paying a massive premium for a very short period of liquidity. Your effective APR shoots up well over 120%.
That is a staggering trap. You are essentially penalized for being successful and retiring the obligation early. It makes it impossible to use traditional loan logic.
You have to throw traditional loan logic out the window. You cannot look at a 1.20 factor rate and think 20% interest. You must calculate the total payback amount in raw dollars and decide if the return on your investment will actually exceed that fixed dollar cost.
And the cost isn't even the most dangerous part, it's the repayment frequency. Our sources put a huge emphasis on cash flow mismatches because traditional loans are paid monthly. Alternative loans are often paid weekly or even daily.
Daily Automatic Clearinghouse, or ACH, withdrawals are very common with merchant cash advances. The lender simply pulls a fixed amount or a fixed percentage from your operating account every single business day.
Now, if I am a restaurant with steady, high-volume, daily credit card sales, I can see how that works. A few $100s comes out every day, I barely notice it. But what if I run a B2B consulting firm? I invoice my clients, and I only get paid once a month on the 30th.
Then a daily ACH withdrawal is fatal to your business.
It's like running a car engine without oil. You might make it a few miles, but catastrophic failure is mathematically guaranteed. You're being drained every single day while waiting 30 days for revenue to replenish the account.
That is a perfect analogy. You are guaranteeing a cash flow crisis. You must match your loan payment frequency to your natural revenue cycle. If revenue comes in monthly, your debt service must be monthly. Mismatching those two forces you into a situation where you might bounce the daily payment. And the moment you bounce a payment, you step on a legal landmine.
Right. And here's where it gets really interesting and honestly a bit terrifying. I read through the notes from J. Singer Law Group regarding what happens when you default on an alternative loan. There is a specific legal mechanism called a confession of judgment, or COJ. How does this actually function?
A confession of judgment is a legal clause heavily utilized by alternative lenders, particularly those operating under New York State commercial law. When you sign the funding agreement, you simultaneously sign a sworn affidavit admitting that you owe the money and voluntarily submitting to a court judgment against yourself.
So I am effectively signing a legal surrender document before I even receive the money.
You are pre-surrendering. If a cash flow mismatch causes you to miss a few daily payments, the lender does not have to file a lawsuit. They don't have to serve you with papers or take you to trial. They simply take that pre-signed COJ to a county clerk in New York, file it, and the clerk enters an official legal judgment against your business.
Without ever notifying me.
Without any prior notification whatsoever. The first time you learn about it is usually when you log into your business bank account and see a zero balance because the lender has already executed the judgment and instructed the bank to freeze your funds.
That is astonishing. If things go south, you have no shield. You wake up on payroll Friday, the funds are frozen, and your business is effectively dead in the water, with zero opportunity to defend yourself in court.
It is a devastating tool, which is why it's critical to have a business attorney review these contracts.
Yeah.
You want to avoid lenders who aggressively utilize COJs. And an attorney can also spot another fatal practice mentioned in the sources, stacking.
Oh, stacking. The data shows this is a massive red flag. This happens when a lender offers you a second or third advance while you are still making daily payments on the first one, right?
It happens all the time. You take an advance, you get halfway through paying it off, and cash flow gets tight often because of those daily payments. The lender, or sometimes a competing lender who scrapes public records, calls you up and offers to wire you another $50,000 today.
And if I accept it, how does that legally siphon my revenue?
Because now you have two daily ACH sweeps hitting your account simultaneously. Or worse, the lenders require you to set up a lockbox account.
What is a lockbox account?
It is a bank account completely controlled by the lender. You are legally required to route all your incoming customer payments into that lockbox first. The lender takes their daily cut for both of the stacked advances and then forwards the remainder to your actual operating account.
They get paid before I even see my own revenue, and if I stack 2 or 3 of these, I assume those daily cuts get massive.
They consume 20, 30, sometimes 40% of your gross daily revenue. Your business is suffocated. It becomes a mathematical impossibility to buy inventory or pay employees. Stacking almost inevitably leads to default.
It sounds incredibly predatory. The sources do point to some pushback against these practices, though. California recently enacted Assembly Bill 483 to regulate this space. Why was AB 483 necessary?
AB 483 was drafted specifically to stop lenders from burying punitive fees in the fine print. Before this law, a lender might hide a massive cancellation fee behind a digital hyperlink in the contract. If you tried to exit the agreement, you'd suddenly be hit with thousands of dollars in undisclosed penalties that were never actually printed on the page you signed.
That's insane. They couldn't even put the fee in the actual document. They hid it on a website that could change at any time.
Precisely the problem. AB 483 mandates total transparency. It caps early termination fees on fixed-term installment contracts at 30% of the remaining balance, and it strictly bans lenders from obscuring penalties behind hidden fine print hyperlinks. It is a vital step toward forcing alternative lenders to clearly state the true cost of their capital.
That underscores the main takeaway for anyone listening. You must aggressively protect yourself. The alternative lending market offers incredible speed, but it lacks the guardrails of traditional banking. You have to be your own guardrail.
Exactly. The speed of alternative lending provides vital lifelines. But you cannot sacrifice your legal protection for that speed. You have to walk away from any lender who won't clearly state the total dollar cost of capital.
Let's tie all of this back to you, the listener. You receive that bank denial. We've established that a rejection is just a detour. It means your business profile, maybe your time in business, or your personal credit just doesn't fit the bank's backward-looking algorithm.
But you have options that look forward. You can use invoice factoring to bypass debt entirely by leveraging your client's creditworthiness. Or you can explore working capital advances that underwrite your real-time revenue velocity.
But you have to move strategically. You cannot let desperation dictate your terms. You must match your repayment cadence to your actual revenue cycle. You must calculate the total dollar payback amount instead of guessing at factor rates. And you have to scour the contract, ideally with an attorney, for pre-surrender clauses like confessions of judgment.
The capital's out there. It's really about finding the structural fit for your specific cash flow without signing away your future.
I want to leave you with one final provocative thought from the research regarding where this is all heading. Because we are currently watching the rise of what's called embedded financial infrastructure.
This is a profound shift in the market. Platforms that you already use to run your business, like Shopify, Square, or Stripe, are becoming lenders themselves.
Because they already have the real-time data. They see every sale, every return, every customer interaction the second it happens. They can offer you a working capital advance with one click inside your dashboard because they already know your exact revenue velocity.
Which forces us to ask, in the next 5 to 10 years, will the traditional concept of applying for a business loan or relying on credit bureaus become totally obsolete? If the software running your business can automatically advance you capital the moment the math makes sense, the rigid gatekeepers of traditional banking might simply be bypassed entirely.
It's a fascinating structural shift to keep an eye on as you plan your business's future. Take a breath. A bank denial doesn't define your business's potential. It is just one slow, very rigid door closing. There is an entire hallway of dynamic, fast-acting doors out there ready to fund your growth. Now you know exactly how to check the hinges before you walk through.